All right, folks, welcome to the wild side of investing. Today, we're stepping outside the world of plain vanilla stocks and bonds. This module is all about alternative investments. If traditional assets are your meat and potatoes, think of alternatives as the spicy side dishes. A little more complex, but packed with flavor if you know how to handle them. As a CFA Level 1 candidate, your job is to understand how these non-traditional assets work, why institutional investors use them, and what makes them stand apart. We're going to cover their unique features, their structure, and the key categories like private capital, real assets, and hedge funds. This isn't just theory, these are tools used in real portfolios to manage risk, boost returns, and diversify away from the market noise. Let's kick things off with a simple question. What exactly are alternative investments? They're basically anything that doesn't fall into the traditional basket of publicly traded stocks, bonds, or cash. Instead, we're talking about assets like private equity, venture capital, real estate, commodities, hedge funds, and even digital assets like cryptocurrencies. So why are these alternatives gaining so much attention? Two big reasons. First, they offer the potential for higher returns. And second, they help diversify your portfolio. These assets don't always move in the same direction as the stock market. So when your S&P 500 index fund is taking a hit, a solid real estate investment or a smart hedge fund position might help cushion the blow. But of course, there are trade-offs. You don't get these benefits for free. Most alternative investments are illiquid, meaning you can't just cash out on a whim. They often require longer holding periods and bigger capital commitments. Plus, the strategies can get pretty complex, so you need to know your stuff or partner with someone who does. In terms of how to get exposure to these investments, you've got a few options. Some investors go direct, especially in private equity or real estate. Others do co-investments, teaming up with bigger players. But most go the fund route, pooled vehicles managed by pros, which offer access and diversification, but also come with fees that can eat into your returns. Let's now get into the DNA of alternative investments, what makes them tick, and how they behave differently from traditional securities. First up, these investments usually require a lot more know-how. You can't just Google the price of distressed debt or timberland and call it a day. You need real due diligence, industry knowledge, and a good sense of risk. Another major feature is diversification. Because alternatives often have a low correlation with equities and fixed income, they can help smooth out portfolio returns. Think about how gold or farmland performs when equity markets are volatile. Sometimes they hold up better, offering some protection. But these advantages come with strings attached. Alternatives are usually illiquid, meaning your money could be locked up for years. And they often require a longer-term horizon. You're not flipping a startup in 6 months or harvesting timber overnight. These are slow plays, measured in years, not quarters. Also, let's not forget the structure of incentives. Many alternatives come with performance-based fees. You might hear terms like 2 and 20 in hedge funds. That's 2% management and 20% of profits. These structures are meant to align managers' interests with investors, but they can also make costs steep. Now let's look at the 3 big categories of alternative investments. First, we've got private capital. This includes private equity and private debt, basically funding companies outside the public markets. If you've ever watched a company go private to restructure and relaunch stronger, that's private equity in action. Private debt, on the other hand, is about lending to companies without going through traditional bond markets. When you hear private equity, think of firms like Blackstone or KKR. They step in to buy entire companies, especially ones that are mature or struggling, with the goal of turning them around. These firms often take a company private, make operational improvements, then sell it later at a profit. For example, Blackstone famously acquired Hilton Hotels and helped restructure the business before taking it public again. Now, on the private debt side, think of firms like Apollo Global Management. They provide financing to companies that can't or don't want to issue traditional bonds. Instead of going to a bank, these companies borrow from private lenders with more flexible terms. Then there's venture capital. These are the folks throwing money at startups with big ideas and zero revenue. High risk, high reward. Think about how early investors in Uber or Airbnb made fortunes, but also how many startups flame out before ever turning a profit. So, guys, venture capital, which is all about early stage, high growth startups. If you've watched shows like Shark Tank or read about Sequoia Capital or Andreessen Horowitz, you've seen VC in action. These firms invested early in companies like Airbnb, Stripe, and DoorDash, all of which started as small, scrappy teams and exploded into household names. And in tougher markets, distressed debt investors look for companies teetering on the edge of bankruptcy. For instance, Oaktree Capital is known for snapping up distressed assets, betting on recovery or asset liquidation. Next up are real assets, stuff you can touch like land, buildings, and even toll roads. Real estate is probably the most familiar. You invest in a commercial building, collect rent, and maybe see the property appreciate. Infrastructure investments like airports or highways generate steady cash flows, often backed by government contracts. Think tangible things like land, buildings, and natural resources. In the real estate space, companies like Brookfield Asset Management or Prologis invest in massive portfolios of commercial properties, from logistics warehouses to office buildings. These investments generate steady rental income and can appreciate in value. Infrastructure assets like toll roads or airports are another slice of real estate. For example, Macquarie Infrastructure has stakes in utilities, telecom towers, and energy pipelines, which generate long-term, stable cash flows. Natural resources, that includes farmland, timberland, and mineral rights, assets that can generate income from harvesting or leasing. Under natural resources, you're looking at undeveloped land or things you can extract, like farmland, timberland, or oil fields. Manulife Investment Management has large timberland portfolios, while companies like Farmland Partners let investors tap into agricultural returns. These aren't flashy, but they're tied to real, enduring value. You're essentially betting on the world's need for food, wood, and energy. And don't forget commodities. These are raw materials like oil, wheat, or copper. They don't pay you income, but their prices can move based on global supply and demand. They also serve as inflation hedges and tend to zig when equities zag. Commodities are standardized goods used in the production of other goods. Think of wheat, copper, oil, and even gold. Commodity investing doesn't mean you're storing barrels of crude in your garage. It often involves futures contracts or exchange-traded funds, ETFs. Big players like Glencore or Trafigura dominate global commodity trading. Investors use commodities as inflation hedges or diversification tools because their performance often moves opposite to traditional stocks. Finally, there are digital assets, still evolving but increasingly relevant. From cryptocurrencies to tokenized securities, these are assets stored electronically but with real-world value and market dynamics. Last but not least, hedge funds. These are private vehicles that can invest in just about anything. Some hedge funds go long and short, some use derivatives, some focus on market events or macro trends. They can be nimble and aggressive using tools that traditional mutual funds simply can't. So, folks, hedge funds use creative high-risk strategies like short selling, leverage, and derivatives to chase outsized returns. Think Bridgewater Associates, Citadel, or Renaissance Technologies. These firms don't limit themselves to one asset class. They play wherever the opportunity is. A hedge fund might short a struggling tech stock, go long on gold futures, and bet on interest rate movements, all at the same time. For those who want exposure without picking individual hedge funds, there's the fund of funds model, where firms like BlackRock or UBS offer diversified hedge fund portfolios. So when we say fund of funds, basically it's a basket of hedge fund strategies under one roof. Now, what is that? Well, think of it as a fund that doesn't invest directly in stocks or bonds or real estate, but instead invests in other funds. Yep, it's like a fund that builds a portfolio out of other investment funds. Could be hedge funds, private equity funds, or even mutual funds. Why do investors do this? Two big reasons: diversification and professional access. A fund of funds gives you exposure to a wider range of strategies and managers, which is especially useful if you're an institutional investor or a high net worth individual looking to tap into top tier funds that usually aren't easy to access. But here's the catch: it often comes with an extra layer of fees, because you're paying fees to the fund of funds manager and the underlying fund managers. So always keep that in mind when evaluating performance net of costs. So that's your overview of what alternatives are and how they behave. And hey, if you want all this organized in a way that actually sticks, grab our FinQuiz Battle Ready Summaries. They're made to help you visualize these concepts and lock them in before exam day. All right, folks. Now that we've got a solid grasp of what alternative investments are and how they're categorized, let's shift gears and talk about how you can actually invest in them. Because here's the thing: it's not just about picking the right asset class, it's also about choosing the right entry point. And with alternatives, that entry point depends heavily on how much capital, experience, and control you want, or can realistically handle. So, broadly speaking, there are three paths you can take to get your foot in the alternative investment door: fund investment, co-investment, and direct investment. And no, this isn't just theory. Institutional investors like sovereign wealth funds, pension funds, and even university endowments like Harvard and Yale have been navigating these very paths for years. Let's start with the most accessible option: fund investment. This is basically the starter kit for most investors, especially those who don't have the time or expertise to dig through individual assets. Instead of picking a specific real estate project or a distressed company to buy into, you invest in a professionally managed fund. That fund then spreads your capital across a diversified portfolio of alternative assets. Think Blackstone's private equity fund or Brookfield's infrastructure fund. Those are real-world examples of funds pooling billions from investors around the world. Now, these funds usually charge two types of fees: a management fee, which is like the cost of having someone drive the car for you, and a performance fee, which kicks in if they exceed a benchmark. Think of it like a bonus for beating expectations. The upside? You get access to complex deals without needing to manage them yourself. The downside? You give up control, and you can't just walk in and out of the investment like it's a stock trade. You're in it for the long haul, and you better be cool with that. But let's say you've been in the game a while, and now you want a little more control. You're not quite ready to go solo, but you're ready to ride shotgun. That's where co-investment comes in. Imagine you're a limited partner in a fund and they bring you into a specific deal. You don't have to manage the whole fund, but you get to invest in a particular opportunity alongside the fund manager. It's like getting backstage access without organizing the whole concert. Co-investing is a way to cut fees, gain experience, and have a closer look at the underlying asset. For example, a private equity fund might be acquiring a logistics firm and they offer you a slice of that deal. You bring your capital, maybe even your industry insight, and the fund manages the rest. You're learning by doing, but with training wheels. That's why many institutional investors use co-investing as a stepping stone to eventually making direct investments. Now, let's talk about direct investing. This is where the training wheels come off. This route is mostly for the big players, think Singapore's GIC or Norway's government pension fund Global, who have teams of analysts, lawyers, and deal makers in-house. When these institutions make a direct investment, they're not going through a fund. They're buying a stake in a private company, developing a toll road, or acquiring timberland themselves. No middleman, just full control. But with great power comes, you guessed it, a boatload of responsibility. You're the one making the call on valuation, negotiating the deal, arranging the financing, and managing the asset post-investment. Sure, the returns can be phenomenal and you save big on fees, but if the deal goes south, there's no manager to blame. It's on you. And here's a little exam tip while we're at it. The CFA Level 1 exam might present a scenario where an investor has limited experience and capital. In that case, fund investment is your best answer. If they've got some experience and want lower fees plus a chance to learn, co-investment is probably the move. And if it's a large institutional investor with internal capabilities, that's a direct investment all day. Also, keep an eye out for details on fee structures. Performance fees and pre-commitment capital requirements pop up a lot in practice questions. The examiners want to know if you understand how the investor-manager relationship works, especially around incentive alignment and liquidity constraints. So to wrap this up, alternative investment methods are really about trade-offs. Do you want convenience or control? Lower fees or professional management? A hands-off approach or deep engagement? Each method opens different doors depending on your capital base, knowledge level, and appetite for risk. And if you're wondering how to keep all this clear in your head, our battle-ready summaries at FinQuiz are designed exactly for that. They show the differences between these approaches in clean, visual flowcharts. Seriously, if you're gearing up for the exam, having those summary sheets for all learning modules and our Stanley Notes, question bank, and mocks by your side can make all the difference. You'll find the link in the description. All right, let's move on to the next part. All right, team, let's talk structure. Now, if you've been wondering how all these complex investments get organized behind the scenes, this is where the real magic and paperwork happens. See, alternative investments don't just sit in your brokerage account like a share of Apple stock. They're more like long-term relationships, and because of their illiquid, complex, and often high-risk nature, you need the right structure in place to protect both investors and managers, and more importantly, to align their incentives. The most common ownership structure you'll run into in the alt space is the limited partnership, often just called an LP. In this setup, the investors are called limited partners. They're the ones providing the capital, but they don't get involved in day-to-day decisions. They're basically the quiet backers of the fund. Then you've got the general partner, or GP. This is the person or firm calling the shots, managing the money, sourcing the deals, negotiating terms, and hopefully generating those sweet, sweet returns. So for example, if you invest in a KKR private equity fund, you'd be the LP and KKR would be the GP. And here's where it gets interesting. While LPs have limited liability, GPs take on unlimited liability. Yep, if something goes wrong, the GP is on the hook. Yeah, that's why GPs tend to charge fees, more on that in a minute, and why LPs are pretty hands-off in the whole process. Now, this whole arrangement is governed by something called the Limited Partnership Agreement, or LPA. This is the legal document that lays out all the rules: how capital is drawn down, how profits are split, how long the fund runs, and so on. But here's a fun twist. Sometimes GPs and certain LPs strike side deals called side letters. These are private agreements that grant special terms, maybe early access to information, better fee structures, or co-investment rights. Think of it like backstage passes for your VIP investors. There are also some specialized structures in the alt world. Ever heard of public-private partnerships, or PPPs? These are used mostly in infrastructure, say building a toll road or airport. You'll have private investors team up with governments, and the whole thing's run through a special purpose vehicle that raises capital, builds the asset, and then either sells it off or returns it to the public sector down the road. Another popular setup, especially in real estate and energy, is the Master Limited Partnership, or MLP. This structure trades like a stock, but operates more like a partnership, giving investors access to illiquid asset classes with a bit of liquidity. And then you've got REITs, commodity funds, and ETFs. These are what we call liquid alts. They let retail investors dabble in alternatives without the long lockups and steep minimums. Okay, let's shift gears to compensation structures, because let's be real, this is where incentives matter. Most alternative funds charge a combination of management fees and performance fees. The management fee is the flat rate, usually around 1 to 2% of assets under management or committed capital. It's what pays the bills, covers staff, research, operations. But the real prize for GPs is the performance fee, often 20% of the profits. This is also called carried interest. And trust me, when the fund does well, this is a massive payday. But to keep things fair, most funds build in something called a hurdle rate, usually around 8%. That means the GP doesn't get their carry until the fund returns at least 8% to the LPs. If they don't hit that mark, no performance fee. Now, there are two types of hurdle rates: hard hurdles and soft hurdles. With a hard hurdle, the GP only gets carry on returns above 8%. With a soft hurdle, as long as the fund clears 8%, the GP gets carry on the whole amount. You can guess which one investors prefer, hard, and which one managers prefer, soft. Let's not stop there, because now we've got all kinds of fine print baked into the LPA, like catch-up clauses. This clause helps the GP catch up to their agreed 20% share of profits after the LPs hit their hurdle. Then there's the high water mark, which makes sure investors aren't paying performance fees multiple times for the same gains. If a fund loses money 1 year, the manager has to get back to the previous high before earning any new carry. Another big one is the clawback clause. If a GP gets a huge carry early on, let's say from a successful IPO, but then tanks the rest of the fund, they may be required to return part of these fees to make sure LPs receive their fair share first. It's like performance-based accountability built into the contract. Finally, we've got waterfall structures. That's the order in which profits are distributed. In an American-style waterfall, payouts are done deal by deal, meaning the GP can get carry right away. This favors the manager. In a European-style waterfall, LPs get all their committed capital back and hit their hurdle rate before the GP gets a dime. This setup obviously favors the investor and is more common in conservative institutional funds. On the CFA exam, you might get a scenario where a GP is earning carry even though the LPs haven't fully recovered their capital. If it's a deal-by-deal structure with no clawback, that's technically allowed. But if you see the words European waterfall or high water mark, you know the investor's interests come first. So keep an eye out for these clauses. They love to test them under different names. All right, folks, let's break down how these private investment structures really work. Not in a textbook way, but in a way that actually makes sense when you're looking at how money moves between investors and fund managers. So imagine you're part of a private equity fund. Say it's called Growth Edge Capital Fund 1. You, as the investor, are what we call a limited partner, or LP for short. You've committed, let's say, $10 million to the fund. The manager, known as the general partner, or GP, is the one calling the shots, making the investments, managing the deals, the whole 9 yards. Now, here's the deal with fees, and this is where it gets interesting. You're going to pay a management fee, maybe 2% a year, just to keep the lights on and the GP's team working. But the real money for them, that comes from performance fees, also called carried interest. That's usually around 20% of the profits, but only if they actually perform. But the game doesn't start until we talk about the hurdle rate. Think of this as the GP's prove it threshold. Usually it's around 8%. The GP has to beat that before they earn any performance fee. So if the fund only returns 6% in a year, no carry, no bonus. It's like, nice try, but come back when you've delivered. Now let's say in year 1, the GP knocks it out of the park. One of the companies they invested in sells for a huge gain. Boom, the fund's return is, say, 25% for that year. But you, as the LP, don't just start handing over 20% of that profit yet. Nope, not if the fund uses a European waterfall structure. In a European-style waterfall, the GP doesn't get any performance fee until you, the LP, get all your money back, plus that 8% preferred return across the entire fund. Not just one good deal, but once that hurdle is cleared, the catch-up clause comes into play. This clause allows the GP to catch up and take 100% of profits for a little while until they've earned their full 20% share overall. It's like giving them a fast lane temporarily after you've already been made whole. Then things turn. Let's say the next few years don't go so well. One investment just breaks even. Another one tanks. Now the fund's average return falls below 8%. But remember, the GP already took carry in year 1. This is where the high water mark and clawback clause protect you. The high water mark says, hold up, you don't get paid again until the fund value gets back to its previous peak. And the clawback, that's your insurance policy. If the GP got paid too much early on because returns didn't hold up over time, they're on the hook to give that money back. Yep, that's right. If the fund overall ends up underperforming, the GP must return some or all of their carry to make sure you're not left holding the bag. And finally, how the profits are split, the waterfall. There are 2 main flavors, the American waterfall or deal-by-deal structure, where the GP can start taking carry as soon as a single investment pays off. Great for them, a bit risky for you. The European waterfall or whole of fund approach, where the GP only sees performance fees once the entire fund has paid you back with your preferred return. Safer, more LP friendly. So when you're looking at how a private fund is structured, don't just ask what the return target is. Ask how the cash flows will actually be shared. Who gets paid first, under what conditions, and what happens if things go south. On the CFA exam, they love to test whether you know what protects the investor. So if a question mentions a GP taking profits early and then losses occur later, think clawback. If you see a fund with a great first deal but poor performance overall and the GP still got carry, again, clawback. If it says a GP can't take carry until after all capital and hurdles are returned, European waterfall. And if they mention the GP getting 100% of profit for a bit, that's your catch-up clause. And hey, if keeping all this straight feels like a lot, you're not alone. That's why our battle-ready summaries give you visuals of every clause, structure, and payment term so you can lock it all in before exam day. Seriously, it's the difference between memorizing and actually understanding how the flow of money works in alternative investing. Grab those from the link below and check out our Stanley Notes and mock exams while you're at it. They'll get you ready to own this topic. So there you have it, folks. Behind every private fund or alternative investment deal, there's a whole playbook of rules. Who gets paid, what, when, and under what conditions. It's not just about making big returns. It's about managing expectations, aligning incentives, and protecting investor capital over the long haul. That's what makes this part of the curriculum so interesting. It's not just theory. These structures are used every day in billion-dollar funds, from Blackstone's private equity empire to Brookfield's infrastructure projects and KKR's real estate deals. If you can master the flow of capital in these setups, who puts in the money, who runs the show, and how performance gets rewarded, you'll be miles ahead for the exam and in real-world investing too. You've got this. Just keep showing up, keep reviewing smart, and remember, confidence on exam day comes from clarity today. Good luck and go crush it.